There's something happening in global financial markets right now that most people watching the daily headlines are completely missing. It is not showing up in the stock market tickers. It is not the subject of breaking news alerts. But if you look closely at the data, at what the largest and most sophisticated investors on the planet are actually doing with their money rather than what they are saying, you start to see a pattern that is clear, consistent, and accelerating. Smart money is quietly repositioning, not in a panic, not all at once, steadily, deliberately, and in a direction that tells you something very important about where some of the most experienced market participants believe this economy is heading. And today I want to walk you through exactly what that pattern looks like, what is driving it, and why precious metals like gold and silver are sitting right at the center of this story. Before we go any further, I want to be clear that everything in this video is purely educational and informational. Nothing here is financial advice. Every person's financial situation is different, and any investment decisions should be made with a qualified financial professional who understands your specific circumstances. With that said, let us get into it. Let me start with a number that I think frames everything else we're going to talk about. According to the International Forum of Sovereign Wealth Funds, working with data from State Street, major institutional investors managing more than $53.8 trillion in combined assets have been making a notable shift in their portfolios entering 2026. They are reducing their U.S. equity holdings. They are cutting their dollar exposure, and they are rotating that capital into Japan, Europe, and emerging markets as part of what the report describes as a wider move toward regional diversification, $53.8 trillion. That is more money than most people can begin to comprehend, and the institutions managing it are quietly moving it away from the United States. Now, that is a remarkable sentence, and the important word in it is quietly, because that is what makes this a liquidity warning rather than a headline story. When smart money moves, it does not announce itself. It does not hold a press conference. It does not post about it on social media. It leaves footprints in the data, in the flow numbers, in the positioning reports, and the fund flow statistics that most ordinary investors never think to look at. And those footprints are telling a very specific story right now. To understand why this is happening, you need to understand what liquidity actually means in the context of global markets, because it is one of those words that gets used constantly without much explanation. At its most basic level, liquidity is the ease with which you can buy or sell an asset without significantly moving its price. When a market is highly liquid, there are many buyers and sellers, transactions happen smoothly, and prices reflect genuine supply and demand. When liquidity dries up, when the buyers start stepping back, spreads widen, prices become erratic, and assets that looked perfectly safe start behaving in ways nobody expected. The U.S. market has enjoyed exceptional liquidity for decades, partly because of the dollar's reserve currency status, partly because of the sheer size and depth of American capital markets, and partly because global investors have always treated American assets as the default safe harbor. Liquidity is not permanent, it is not guaranteed. And what we are seeing right now is some of the most sophisticated money managers in the world quietly beginning to hedge against the risk that U.S. market liquidity may not be as reliable in the coming years as it has been in the past. The reasons behind this shift are not mysterious, if you look at them honestly. The United States is carrying a national debt that has crossed $39 trillion. The government is spending more than 23 cents of every dollar of revenue just to service the interest on that debt, money that is not going to infrastructure or education or any productive purpose, but simply to pay the cost of past borrowing. $9 trillion in existing treasury debt is being refinanced this year at interest rates that are 4 to 6 times higher than when that debt was originally issued. The Federal Reserve is caught between inflation that remains above its target and an economy that is showing real signs of slowing, having shed 92,000 jobs in February against expectations of a gain, and having seen GDP revised down from 4% to 7%. The Iran conflict has pushed oil above $100 per barrel, creating an inflationary shock that is already working its way through the supply chain and is expected to push consumer prices meaningfully higher. And on top of all of this, the U.S. stock market entered 2026 at its second most expensive valuation in 155 years of data. According to research by Nobel Prize-winning economist Robert Shiller, with the NASDAQ now in correction territory, and the broader S&P 500 down more than 7% year-to-date. When you step back and look at all of those variables together, it is not hard to understand why institutions managing trillions of dollars are becoming more cautious about their concentration in U.S. assets. It is not pessimism. It is not a lack of confidence in America broadly. It is risk management. It is the recognition that any portfolio that has become deeply concentrated in one country, one currency, and one asset class is carrying more risk than most long-term investors would choose to hold deliberately. And the rotation that is happening right now reflects a recalibration rather than a wholesale exit. But here is the crucial point. When institutions that manage $53 trillion recalibrate, even modestly, the impact on market prices and liquidity conditions can be significant. A 1% shift in allocation across a portfolio that size is $538 billion moving from one place to another. It is not a rounding error. That is a tidal wave in slow motion. So where is that money going? The data gives us three clear answers. First, it is going into international equities, particularly European and Japanese markets that came into this cycle at much cheaper valuations than the US. Morningstar's fund flow data shows that the fastest growing fund categories in international markets over the past 12 months are focused on emerging markets and markets in European equities, while some US stock fund categories are actually seeing net outflows. European markets have outperformed US markets significantly this year, driven partly by defense spending increases, partly by improving macroeconomic conditions in Germany and other major economies, and partly by the simple fact that European stocks were priced at a significant discount to their American counterparts. Second, capital is flowing into short-duration fixed income and inflation-protected bonds rather than the long-duration treasuries that institutions traditionally favored. When real yields remain elevated and fiscal risk is a concern, smart money shortens its bond duration to reduce exposure to interest rate moves while maintaining some fixed income allocation. Third, and this is the part of the story that I think is most directly relevant for anyone watching a channel about precious metals, a significant portion of this repositioning capital is flowing into gold. Let me give you the specific numbers because I think they are striking. Global gold-backed exchange-traded funds recorded their 9th consecutive month of inflows in February 2026, with the strongest 2-month start to a year the World Gold Council has ever tracked. Total global gold ETF holdings rose to a new all-time high, reaching 4,171 tons. Total assets under management in gold ETFs globally hit a record $701 billion. North America led those inflows, meaning it is not just international investors hedging dollar risk. American investors are buying gold too, and in significant quantities. Goldman Sachs, which is not exactly known for perma-bullish gold commentary, did its gold price forecast to $5,400 per ounce as its base case for this year, while noting that risks to that forecast are asymmetrically skewed to the upside. And Goldman identifies 3 structural drivers behind gold's continued demand that it expects to remain firmly in place, regardless of short-term price fluctuations. Central bank buying, which it projects at approximately 60 tons per month throughout 2026. GF inflows from Western investors that have been running ahead of what interest rate dynamics alone would explain. And what Goldman calls the debasement trade, which is essentially a broad-based shift among investors who are concerned about currency erosion, rising sovereign debt, and the long-term sustainability of current fiscal trajectories. Debasement trade framing is important because it helps explain something that can seem counterintuitive. Gold prices have remained elevated even as the Federal Reserve has maintained a relatively restrictive policy stance. Normally, when rates are high and real yields are positive, gold struggles because it pays no income and therefore has an opportunity cost compared to yield-bearing assets. What we are seeing in 2026 is gold holding up despite those headwinds because the demand for gold is not primarily coming from people betting on rate cuts. It is coming from people hedging against a broader set of risks, fiscal risks, geopolitical risks, currency risks, and the risk that the post-war financial architecture that has structured global capital flows for 80 years is in the process of a slow but meaningful transformation. A modest 1% reallocation from government bonds and equities into gold across the global investment universe would represent approximately $2.5 trillion flowing in an already tight physical gold market. The kind of structural demand shift is not something that gets reversed by a single Federal Reserve meeting or a change in a quarterly inflation reading. Silver is a part of this story too, and it is worth spending a moment on because it tends to get overshadowed by gold even when its dynamics are compelling. Silver benefits from many of the same forces driving gold demand: the inflation hedge argument, the currency diversification argument, general movement toward hard assets. But silver also has an industrial dimension that gold largely does not. Silver is a critical input for solar panels, electric vehicles, semiconductors, and medical technology. Global solar capacity additions are breaking records, and silver demand from that sector alone is projected to remain at historically elevated levels through the rest of this decade. What this creates is a situation where silver is being pulled in 2 directions simultaneously, toward gold by investor demand and toward a range of industrial uses by the green energy transition. That dual demand dynamic, combined with the fact that silver has historically traded at a significant discount to gold on a relative basis compared to long-term historical averages, is something that informed market watchers are paying attention to. Now I want to bring this back to the liquidity warning aspect of what we are discussing, because I think it is important not to lose the thread of what this means practically for ordinary investors who are trying to make sense of a complicated market environment. The warning embedded in what smart money is doing is not that the US market is about to collapse. It is not that American companies are going to stop generating profits. It is something more subtle and in some ways more important to understand. It is a warning that the conditions that made a heavily US concentrated portfolio the obvious default choice for the past decade and a half have changed. The tailwinds that pushed US stocks to their second highest valuation in over a century, low interest rates, a strengthening dollar, abundant global liquidity, and the unchallenged perception of American assets as the world's default safe harbor. Those tailwinds are either reversing or diminishing, and in their place, a more complex and more uncertain set of conditions is emerging that rewards a different kind of portfolio thinking. When Charles Schwab's research team surveys the potential risks for markets in 2026, they explicitly call out the narrowing of the premium that U.S. Treasury yields have historically enjoyed over European and Japanese bond yields. The narrowing, they note, threatens to draw money away from U.S. assets and into international ones, which would likely benefit from higher rates overseas. This is not a fringe concern from an obscure blog. This is mainstream institutional analysis saying that the fundamental mechanics that have made U.S. assets the default destination for global capital are becoming less favorable. And when the mechanics change, the flows follow. That is precisely what the $53.8 trillion institutional data from the International Forum of Sovereign Wealth Funds is showing us. So what should you do with all of this? I want to be very direct that this video is educational and informational, not financial advice, and that any decisions about your own portfolio should involve a qualified professional who understands your personal situation, your risk tolerance, your time horizon, and your goals. What I can offer is context. The context is that the smartest, most experienced, best resourced institutional investors in the world are paying attention to liquidity conditions in U.S. markets in a way they have not needed to for a very long time. They're diversifying their geographic exposure in a way they have not done at this scale since before the era of U.S. market dominance. And they are increasing their exposure to gold and real assets at a pace that has driven those markets to historic highs in terms of ETF inflows and institutional participation. Those are facts derived from the data from fund flow reports, from sovereign wealth fund disclosures, from World Gold Council research, and from major bank analyst reports. They are not predictions. They are descriptions of what is actually happening right now. History offers some perspective on moments like this. There have been previous periods when global capital began to shift away from what had been the dominant market and currency and toward a more diversified set of alternatives. Transition from British sterling dominance in the early 20th century, the collapse of the Bretton Woods gold standard in 1971, the dollar weakness cycle of the 1970s, the emerging market decade of the 2000s when international stocks massively outperformed U.S. equities for nearly 10 consecutive years. None of these transitions happened overnight. They unfolded over years with significant volatility in both directions along the way. People who were positioned for the transition, who had diversified exposures, who held real assets alongside their equity and bond allocations, tended to navigate those periods better than people who were fully concentrated in what had worked in the prior decade. The historical pattern is not a guarantee of what will happen next, but it is a useful frame for thinking about what the current data is suggesting. The key thing to watch going forward is the direction of capital flows, not just the prices. Prices can be misleading in the short term because they are influenced by so many factors simultaneously. But flows tell you what investors are actually doing with real money. And right now, the flows are telling you that gold ETFs are at all-time highs in terms of assets and holdings, that institutional investors are reducing U.S. equity and dollar exposure, that emerging market and European fund categories are seeing the strongest inflows in years, that Goldman Sachs, the World Gold Council, State Street, Morningstar, and virtually every major institutional research outfit is flagging the same structural story, which is that the conditions that made the last decade extraordinary for U.S. markets are being replaced by conditions that call for a broader, more globally diversified approach that includes meaningful allocations to real assets. That is the liquidity warning embedded in what smart money is quietly doing right now. It is not a fire alarm. It is more like a smoke detector going off in a distant room. The house is not on fire yet, but the people whose job it is to notice these things are paying attention, and they are repositioning accordingly. Whether you are an experienced investor or just beginning to learn about how these markets work, understanding the signals that sophisticated capital is sending is one of the most valuable skills you can develop, because markets are ultimately just millions of individual decisions about where to put money, and the decisions that tend to set the direction are made by the largest, most informed participants. Right now, those participants are sending a clear signal. Quietly, methodically, and in ways that most people are not noticing. They're adjusting their exposure to U.S. markets and rotating toward international equities, short-duration fixed income, and precious metals. The story the data is telling, and it is a story worth understanding regardless of where you ultimately decide to position your own portfolio. If you found this breakdown valuable and you want to stay ahead of these kinds of market developments, I would love for you to subscribe to this channel and hit the notification bell so you never miss an update. We cover global markets, macroeconomics, and precious metals trends in exactly this kind of depth on a regular basis. I would genuinely like to know what you think about what we discussed today. Are you seeing signs of this liquidity rotation in your own observations of the markets? Do you think gold's current positioning reflects the fundamentals, or is it getting ahead of itself? Leave your thoughts in the comments below. Every comment gets read, and the discussions in the comments section are genuinely one of the best parts of this channel. If you know someone who follows markets or who is trying to make sense of the current economic environment, share this video with them. The more people who understand what the data is actually showing, the better the conversation gets. Thank you for watching, stay curious, and stay informed.